Likewise.
Well, it's over. Summer, huh? I know the calendar says it's not.
Okay.
But it's over. Traffic says it's over.
All right.
That's an amen to that, sister.
Well, I appreciate everybody being here today, and I know the folks from Chicago and Boston are good to be back in the summer weather, if not the season. And we're ready to call roll, please.
Laura Bellin,
Present.
Landon Moore,
Present.
Danny Covey,
Present.
Mark Gardner,
Here.
David Harrington, David Howley,
Here.
Mark Munson, Solomon Ashby, Derek Challenger,
Here.
Shannon Glover, Elizabeth Gooden,
Present.
Cheryl Spivey.
Here.
Thank you.
We have a
quorum. All right, the minutes were emailed some time ago. And are there any corrections? Any edits? If not, I'll entertain a motion to approve them.
I move that we approve as written.
Second.
All right, all in favor?
Aye.
Aye. So done. Now let's move on to our traditional reports. Ms. Spivey.
Taking a look on page 5 at the historic funds statement. We're 1 month. We're 2 months into the year, but we have 1 month of 1 month of statements. So looking at the July statements, if you go to the bottom line, you can see that year-to-date, July to July, is down about 9.3 million. The primary reason for that are the contributions out. So you can see we had $39,000 of income, investment income, $6,000 of return of benefit payments, then 2.5 million of payments out, and an unrealized gain of 516,000, bringing us to a net change for the month of 1.9 million. And the bottom line of our balance is $212,000,000, $14,000. $14,200. And again, a decrease year over year of 9.3 million.
All right. On the report, we have the active participants in the system. Do we have any retirements this month?
If there weren't any applications for either, there was one report to death with a joint annuity payment. And there are 14 active participants in both fire, police retirement, and Portsmouth retirement systems.
All right. OPEB update?
Can I had one question about the fund flows.
Okay.
Sorry.
Okay.
The bottom right, prior year to date. Should the prior year to date be the entire last year? July 18 to July 19, or July to June?
Could do it. We could do it. I think we've been.
Oh no, this is comparing
looking at
to
it
the
month
prior.
month.
You're right. The
Yeah,
prior year to date.
To see what the change has been in a 12-month period.
Okay, I was thinking it was the whole year to date.
Right.
And then would. Okay.
Okay. All right.
And the next set of statements are the OPEB statements. Looking at the market value as of the end of July, you can see it's $4,232,000. So that is 4 million that the city has contributed, plus the earnings to date of $232,000. That is the OPEB fund.
And just a note, Landon will be attending, I think it's the annual meeting, September 27th, and we'll have an update from him next month, at next month's meeting. All right, thank you. New business. We have attached to our information package invoices from John Hancock, 17, 15, and 19. Take a look at those. Any questions? If not, I'll entertain a motion to approve them.
Move to approve the John Hancock invoices.
Second.
All right, all in favor?
Aye.
Aye. Ayes have it, motion's carried. Thank you. All right, Tom, welcome,
Thank you.
as always.
All right, well, good morning, everybody. So there's a separate handout here that I'll refer to. Before I start, I just wanted to check in with regards to the schedule. I'm assuming historically we come down in October with the assigned actuary, so the Andre Stewart, to provide the annual evaluation. So I believe next month's meeting is scheduled for the 10th. I just wanted to make sure that that was still planned.
Yes.
Yeah, okay. All right, so Andre and myself will be back down next month, and Andre will walk through what will be the leading 2019 into 2020 actuarial update. Okay. All right, so for this update, just wanted to give a couple of standard updates, and then I'm just going to spend a couple of minutes. I'll be quick with it with regards to just an overview on some updated procedures of protecting retirement data, participant and plan accounts. Again, just want the committee to be aware and the board to be aware of different things, not necessarily to get too deep into the detail. So there's a lot more here than I'll talk to, but that's part of our approved update. So I just wanted to leave it as that. So that's section is in tab 1 under infrastructure and data security. And I know that both Mr. Challenger and Mr. Glover from time to time talk about one of the focuses, especially around retirement systems and programs, and from an ongoing fiduciary oversight, more so to the provider, but to the board and plan sponsors, is just having an understanding of what's being done to ensure that financial data is being protected. So there's a lot of detail in here, like I said, and I'll just quickly give a few comments to each of the pages, and then if anyone has any questions, feel free to ask. Just on slide 6, so we just take, as you can see here, a multi-level approach. What that means is that starts from the top down. Again, John Hancock is owned and reports up to Manulife Financial, based out of Canada. So Manulife has high-level governing structure on data protection protocols, et cetera. And then we move down to what John Hancock corporate also has in place, which we would follow. And then ultimately, from a retirement plan service perspective, is really what gets into, all of the procedures that are in place and all the services that we have to protect ongoing data at the participant level. And that happens mainly from what we call front-end security. So that's any attempt to come in and access data, whether it's online or calling the phone center. We have infrastructure, which talks about all of our record-keeping systems and the platform that they're on and how that information is protected. And then ultimately operational safeguards, which really just talks to making sure that there's proper procedure that's in place and being checked and audited. And I'll give a couple of comments on each of those in a minute. First off, on page 7, when we look at front-end security, we do have what we call a cybersecurity guarantee in place, and that protects the participant or the member of the plan receiving their retirement benefit. So as long as, if for some reason there would be fraud to take place and someone receiving a benefit, that information is somehow obtained by a fraudster, we will ultimately protect and refund that money back to the participant as long as we don't see that there's been any type of improper sharing of information, that the individual hasn't tried to protect their account, essentially, and as long as they're willing to work with us. So that, and quite honestly, it'd be very difficult in a pension plan for something like this to happen. It's difficult with what we do on a 401k plan too, but with a 401k plan, there's a lot more individual access to your account, opportunities to get money through loans, withdrawals. So it would be more prevalent there. It'd be really, really tough to get at a pension payment. But if it were to happen, we still have that guarantee in place. Page 8 gets into where we look at the front-end security points. So, as I mentioned, this really covers every way an individual would communicate with us, whether it's going online to get information, using our phone center, our voice response unit, or if they're sending in paperwork or we're sending them paperwork. On page 9, there's a list of a lot of what our front-end protection procedures and technology that we use listed out. And this goes from, a number of procedures in place to make sure that accounts are secure, authenticating passwords, not allowing social security numbers. Anytime transactions are placed, we send out email notifications to ensure they were properly requested, et cetera. And then you get into some of the more deeper technology that's used. And 2 items just to highlight on page 10 and 11. So on 10 is something called RSA Adaptive Authentication. This really focuses on the individual communicating to us through the web. So we have technology in place that really looks at every interaction of someone accessing an account. And do we believe that access is legitimate, or is it potentially being done by a fraudster? So there are a host of checks, over 100 factors that are taken into place. IP addresses, where's the request coming from? Is it from a mobile device? Is it from a computer that's been used before? Is it from, a computer that's been used on other accounts possibly? So we run through all of that analysis and essentially grade it as whether it's a low risk or no risk, medium risk, and high risk. Based off of that, and that's done on every attempt behind the scenes. No risk, low risk, the person gets right in. Medium risk, we would send a code to information we had on. So if we had an email, if we had a phone number, we would send a text message code just to validate the user. And if something comes in and is flagged as a high risk, we will restrict access. That information gets reported internally into our groups, and then we would take further action and research into that attempt. The person attempting to get in would be provided with a message that if they need to access their account, they need to call us. And if it's a legitimate request, then our phone center obviously would help the person get in, maybe set up security protocols that haven't been put in place, et cetera. So that happens continuously, and we continue to update some of the technology and the process that's used. Similar for phone calls, something that's called phone printing or pin drop is, again, every call that comes in, there's analysis done of that phone call, where it's coming from, what kind of device is being used, locating the exact place that started the call. Sometimes things bounce around. Is it a phone number we recognize? Even to the point of starting to identify background noise, and is there a consistent pattern for that phone call? Again, through all of that information, if for some reason there's any risk associated to it, We actually don't inform the phone rep of that. We don't want to put them in an uncomfortable position, but the account information may get locked, and they would just communicate to the individual if there was a high-risk situation that their information couldn't be accessed at that time, and we would ask to follow up with that person. Oftentimes, if there are fraudulent attempts, the call just gets discontinued. If it's not, then someone would give their information, we would research it and get back to them. So that's kind of a high-level process, but again, there's a lot of technology behind that's kind of scanning those situations. So, and then from there, you look at the infrastructure security. So this is everything that's based off of the data that we hold, from where is it being held and how is that being monitored to certifications and audits. So we actually are one of the only record keepers that use cloud-based storage technology. We partner with Microsoft and use what's called the Azure cloud. So when you hear about information being saved up in the cloud, that's what we're doing. It's not actually up in a cloud, but it's at really a government-protected data centers that are used across the United States through Microsoft. We have different levels of redundancy, et cetera. And then when you look at certifications, more from an audit perspective, we actually, it's not on here, we just got approved for what's called SOC 2 Type 2. So there's a lot of different audit levels and certifications that you can reach. SOC 1 Type 2 is more about the actual processing, the administration of what's the transactions in the plan. When you look at SOC 2, that starts to look at what are the security protocols and procedures that in place, and are they proper? So that's been audited and approved. And then what was just finalized is SOC 2 Type 2, which says, okay, you have the right controls in place. Are they actually effective? So we, at this point, have the highest level of certification from an industry and a financial institution perspective. And then the last thing I'll mention is there's something called the Spark Data Security Oversight Board. It's a society of professional asset managers and record keepers. So Spark is it's one of the main retirement plan provider industries. We kind of initiated with a host of other financial institutions. There's some listed on page 14. But just to create a joint board and oversight committee where we're all being faced with similar challenges of trying to, individuals trying to get at information fraudulently, and where we can share information and best practices, we're doing that through this oversight board. So just a quick overview, but again, wanted the board to be aware of kind of our ongoing investment and what we're doing to make sure that information is protected and secure. Any questions? All right. In tab 2, as we talked at the beginning of the meeting when it was open, some of this information, as some of what was reported, is a little dated just due to the delay in the meeting. Asset information, assets by investment are shown here. I did look as of last night. The systems were at 206.6 million, so up a little bit from the end of June, which is good. Anytime you see those assets growing, that's certainly a good sign, making up for the benefit payments that are being paid out on a monthly basis. One thing I just wanted to note, for some of you that have seen some of these slides in the past, so on pages 17 and 18, where we list out the investment holdings, where now that a number of investments are being managed outside of our trust company, we're grouping all those together as and calling it the Morgan Stanley Advisory Holding. So that's a group of everything that's being done on the Morgan Stanley side. So you can see that's about 2/3 of the portfolio at this point. And then just moving through, I won't go through all of this, but just quarter-over-quarter updates on participant status breakdown. I know it was communicated earlier, 14 actives in each plan. This also lists out the number of retirees and term with vested benefits in each of the systems. And then a little detail on pages 20 and 21 that looks at some of the financial activity that we report out on a quarterly basis. And then just some detail on who those active participants are. As you can see, as to no surprise, with the frozen system and fire and police, all 14 of the actives are over 21 years of service. So we all know at some point those benefits will start to come due.
Does anything change as far as the administrative services, responsibilities when there's no more actives? Does anything change?
Well, there's just no longer, the only, probably at actives, maybe not so much from an administration. Because if you have term vested, that means you have individuals that still haven't filed for their benefit, but have it available to them. I think once you move where those situations don't exist anymore, then there would be more of a change. Because now we don't have to work with those individuals on the whole submittal process, calculating the benefit or confirming the benefit, putting it into pay.
Is it safe to assume these actives will all retire within about the same time within a 2-year period, or you can't tell?
Well, I can't really tell. I mean,
Okay.
on the fire and police side, there's probably a little bit more certainty because of the age and the years of service.
Right.
On the supplemental side, there was a period of time where some of the city council members received a partial benefit, so that's why you see a couple of different, those could be a little longer. Those could go a little longer.
I mean, 2 of them are in their 40s,
Yeah.
20 years.
And then with regards to pay, you start to factor in the beneficiaries, so that's why, the payments could be in place for quite a number of years. So that's a just high-level update there through the end of the second quarter. And then on tab 3, as generally provide on a quarterly basis, just an update, an overview on plan expense. So just, and one thing to report, and I'm not sure, Brian, if this came up, if you get it, did you talk about some of the expense reductions the other night?
We did, yep.
Yeah, and are you going to talk a little bit more about that today, or?
I can, sure.
So I guess my only point was, if you look at investment management expense, it's down to under 38 basis points now, which is, I'm on page 31. That's been an ongoing decrease with regards to a lot of the investment strategy changes that Morgan Stanley and Greystone Group have been doing. So, ongoing opportunity to look at saving the fund money through investment expense. So,
One comment on that, Tom. That's likely to tick up here a bit because we are going to start funding some of the alternative strategies, particularly, I think the funding date for most, if not all of them, is October 1st of this year. So it'll increase slightly. It won't go up by a lot, but it'll still be below what we were paying before our relationship changed back in October of last year.
yeah, and if you look back 2 years, the investment management expense was around 60 basis points. And that did include some payment to, the third-party investment consultants, but it's still, when you gross it together, it's still down, I think, around 10 basis points or something.
That's right.
So investment management, our expense here at 6.5 basis points, and then total in the right-hand column, and these are taking the most recent quarter activity and projecting it out annually to give you a look at what the expense may be. And then pages 32 and 33, again, I know these are familiar to the group. These list out by investment holding, looking at the expense ratio, what the expense is, if there's any revenue sharing back. So just a couple of comments here. Again, in about the middle of the page, you see that Morgan Stanley advisory account at around 67% of assets. We're receiving a blended expense ratio for everything that's held within there so that we can include it in this. So you see that's at 22 basis points. That's the expense for everything held at Morgan Stanley. And then there still is one investment option that pays back some revenue sharing. So Lazard International Equity they have an expense of 1.05%, but 15 basis points of that expense actually comes back to the plan to offset cost. And that's that $21,873. So we take that into account when we look at our fee, we net that out, and then we invoice the variance. Any questions? Anything else in general for me?
Just one quick question. So look at the Morgan Stanley, that's a combination of your fee plus underlying investment manager fees?
No, so we're not, that's just the investment expense. So the Morgan Stanley, the advisory fee is not included in that.
That's another 10 basis points. We could add it.
Yeah, I mean, I could add it on the summary page, or we could put it in the, wherever it's most appropriate, but.
Wait, so this doesn't, this is the backup for what you show on page 31?
Correct.
So the investment management fees, 37.8, is excluding your 10 basis
Add
points.
another 10.
Yeah, when the pricing structure, the fee structure changed, that fee used to come through us. We used to pay that out, and that's changed, so it came out of our reporting.
Okay.
We can add it back in just to show if the board wants to see all of the costs. at one
That's
day.
why you're saying when it used to be 60, now it's this basically 40 plus 10, 50.
Right, so if you go.
The all-in
Yes,
prior
yes.
to our change to the discretionary relationship was about 60, now it's about
50.
50. Yeah.
52.9.
Correct. So I can put that in on this page so that you can see that, and we'll just footnote that it's not being paid through John Hancock, that's all.
So still net savings of roughly 8 to 10 basis points.
Yep.
Yeah.
Yep.
Which is not insignificant with $200 million.
Right.
No. Correct. And we're, I think we're doing a lot more too, right? So
Right.
we're providing more services and hopefully better results, and the fees have come down at the same time.
All right.
Okay.
Thank you.
Good questions. Thank you, Tom. All right. Is Jim online?
Jim is not on the line. Jim is not able to be here, and he sends his regrets. On the line are some of my colleagues from the home office, from our outsourced chief investment officer group, who works with me in putting the portfolio that we're going to talk about together. So they just dialed in to listen in, and if there are any specific questions that they might be better equipped to answer, we can certainly have them chime in. Otherwise, you probably won't hear much from them. But thank you all for the opportunity to be here with you this morning. We have our report here, the City of Portsmouth Q2 2019 review. These are results through June. We're going to walk through these, and I'll give you an update as to what's going on in the first couple of months here in the third quarter as well. If I can ask the board to turn to slide 3. We show a bunch of squiggly lines here, and at the bottom, numbers that correspond to those squiggly lines. And what we're showing here are the returns that have been earned in major capital market indices since the beginning of this year. Just looking at the table there, the Russell 1000 index, that's an index of large capitalization stocks in the United States. The one below that is more small and mid capitalization stocks in the U.S. The MSCI EFA index is an index of developed non-U.S. equity markets. Think Europe, Japan, Australia. One below that is emerging markets. The one below that is a broad fixed income index. And the last one there, we're showing the results of hedge funds. If you move over to the right of that table, you'll see April, May, June's results, and then the results for the full second quarter. me just point out a couple of things here. So equity markets in the second quarter continued to rally. In the U.S. equity markets, depending on which index we're talking about, we were up anywhere from 3% to just over 4% for the Russell 1000 index. Developed non-U.S. markets were up a little bit more than 3.5%. Emerging markets positive, but underperforming the developed markets. And then you can see bonds had a pretty good result in the second quarter as well. You move to the last column there, where we look at the first 6 months of the year. Stocks were quite strong, particularly in the U.S., up anywhere from, just around 19% for large cap, small, and mid cap stocks in the United States. In absolute returns, the MSCI EAFE index up 14%, still very good result. Again, this is for a 6-month period, but non-U.S. equity markets are lagging the U.S. equity markets a little bit, and emerging markets, you can see, still up, 10.5%. So what's going on in the world in the second quarter? I think, what we saw in the second quarter was really a microcosm of what we've been experiencing really over the last 18 months. Markets appear to be trading off of rhetoric surrounding trade. May was a rough month for equities. You can see there's a lot of red in that column in that table there. What was really happening in May? Well, the G20 met, and there was no trade deal between the United States and China coming out of that meeting. That really disappointed the market. In fact, not too long after coming out of the G12, or the G20, United States said they were going to be rising tariffs. China was adding tariffs of their own. China said, we're not buying any more U.S. agricultural products. There was a heightened sensitivity and a ramping up of the rhetoric coming out of that meeting, when I think the market was expecting, sort of at worst, steady state. And maybe a little sense of optimism that we'd actually get more sort of constructive dialogue or some sort of framework for an agreement coming out of that meeting. It didn't happen, and that's why markets sold off. You fast forward to June, and then things sort of settled down. The rhetoric around trade was, we were going to have a truce now between the U.S. and China, and the administration said we're going to take Huawei, which is a big Chinese technology company, off this list of companies that we were no longer going to sell technology equipment to. And so the market took that as a sign that, wow, maybe things are improving, things are getting better, we're going to, play well in the sandbox again. China at that point pledged that, depending on who you listen to, we'll buy more agricultural products from the United States. That was the administration saying China agreed to it. They actually came out later and said, actually, we never said that. And so you've got this dynamic of somewhat he said, she said. Every few weeks, 3 or 4 weeks, we've got a deal, we don't have a deal. And we're going through that cycle, and the markets are trading off of that rhetoric. So anytime you see sharp moves one way or another in the markets, you can rest assured that when markets are going up strongly, there's probably some, stability in the whole trade situation. May not necessarily have an agreement. The market's just looking for, things to be stable. And then when you see big drawdowns, chances are somebody said that we're going to increase tariffs, or we're going to not sell equipment to this company or that company, or we're not going to buy agriculture equipment. So it's all really focused on trade. But as we'll see in a minute, as we go through some charts here, we think, it's our view, that a lot of the headline trade stories is masking some underlying weakness in the broader economy, and we'll walk through some charts about why we think that's the case. The other issue I think that you had in June of this year was the Federal Reserve now saying, well, I know we've raised rates from 0 to a range of 2.25% to 2.5% in short-term fixed income rates. Now they're saying, at least they were back in the second quarter, well, maybe we need to start cutting rates to stimulate the economy because there's all this uncertainty around trade. maybe there's some underlying weakness in the general economy, so it's the Federal Reserve coming out and saying we're going to do all that we can to extend this economic cycle. In fact, they did cut interest rates in July of this year. And so the expectation is the Fed is going to be much more accommodative in terms of monetary policy in an effort to keep the sort of the economic cycle continuing to move higher.
Ryan, how much does the upcoming election play with your analysts' view of the economy overall?
In general, markets are volatile leading into presidential elections. And that's not to say that it necessarily wants one party to win versus the other. But what the market really wants is some level of certainty. When you add in, the general economy is uncertain to begin with. And then you add into the equation that we don't know who's going to be in the White House, we don't know who's going to control Congress. Uncertainty is bad for markets. So generally speaking, as we're going into an election, markets will be volatile, probably kind of trendless. Some days they'll be up, some days they'll be down, but generally pretty flat. That absolutely factors into our thinking about the level of volatility that we expect in the market. I don't know that we would project one party's winning relative to the other as being good or bad for the market. It's just markets will be volatile, and so we need to be cognizant of that. And for us, it's taking advantage of that volatility because we've got long-term capital that we're investing. If there's a sense that nothing's really changed from the underlying economic perspective, but we get a pullback because of the uncertainty around the election, that's when we want to be a little bit more aggressive maybe in terms of our exposures. Hope that answers your question, David. So that's, and you know, a lot of these trends are continuing in the third quarter. Got a deal, we don't got a deal. Talking to the, federal, I think yesterday or the day before, the president threw out the term the Federal Reserve was a bunch of boneheads, so for not cutting
That
interest
helps a lot.
So, it's the world in which we live. I'm not saying, one person's right and the other person's wrong, but again, it adds volatility, it adds uncertainty. Uncertainty is bad for the markets. Uncertainty with respect to trade is now starting to, in our view, starting to impact some of the underlying economic fundamentals. And again, we'll talk about some of those. So on page 4, a couple of charts here. On the left-hand side is manufacturing data across the world. We're looking at the United States, Europe, and China. And in all cases, you can see a decline in manufacturing activity over recent months. And in fact, anytime you get one of these lines below 50, that means the economy is contracting, or that manufacturing is contracting. So the United States is still slightly positive, but the rest of the world, from a manufacturing perspective, is producing less than it did 6 months ago. On the right-hand side, a lot of the strength in the U.S. economy in particular has been driven by the strength of the consumer. The consumer represents about 70% of the U.S. economy. And so to the extent that unemployment is low, which it has been, as wages start to grow, and we have seen some uptick in wage growth, consumers tend to carry the economy, and that's what we've seen. That's why the U.S. economy has been particularly strong, even in light of all the uncertainty surrounding trade. More people are working today, wages are growing, consumer balance sheets are in pretty good condition, and so they've been driving a lot of the economic growth that we've been experiencing. Here's on page 5 what I mean by a lot of the uncertainty in trade starting to impact the real economy.
Brian?
Yes.
When you talk about consumers, you hear a lot about how consumers are feeling about the
Yeah.
confidence.
Yeah.
Is that playing into any of these reports?
It is. The consumer confidence, and that's that dark blue line on page 4 on the right-hand side. You can see it's strong and has been getting stronger. And the consumer feels good because people are working. But it's our view, I'm going to say something, and I don't mean to spook anybody, but you'll sort of get the sense. The consumer tends to be most optimistic right at the point where things start heading lower. So we think about how strong consumer confidence and how much of a sort of a counter-cyclical signal it is for us about what we think is likely to happen in the future with the general economy. So yes, the consumer is strong, but the fact that the consumer is strong and is so strong actually gives us a little bit of concern. Yes, sir.
Brian, does that have any particular value in terms of when you look at timeframes? We're coming into the fourth quarter,
Yeah.
holiday season, I mean, those kinds of things. From a cyclical standpoint, do those times of year have an impact on consumer confidence?
I think the fact that we're starting to head into the holiday season and the employment picture is so strong, both in terms of the unemployment rate being low and now wages starting to increase, I think you're probably likely to see some strength and continued strengthening in consumer confidence. It's really hard to say in terms of the lead time on when things peak to when you start seeing the impact in the underlying economy. And it's really anybody's guess. And it's really anybody's guess now more so than ever because there's so much unknown about trade, about sort of the ultimate resolution of that, if we're going to have a resolution to that. So,
Thanks.
on page 5, this sort of gets to what I was referring to earlier when I said the trade situation now starting to impact the underlying economy. So what we're showing here on the chart on the top of page 5, in that blue line, is University of Duke does a survey of chief financial officers of major U.S. corporations. And they say, okay, what are your plans in terms of your capital expenditures in the future? How much are you going to be investing in your businesses going forward? And you can see that that's taken a fairly marked downturn. The economy needs businesses to invest in machinery, equipment, to reinvest their profits in their businesses to sustain economic growth in the future. And we think that there's this fairly significant drop-off in expectations of companies reinvesting in their businesses, largely because there's such uncertainty around trade. So this is what I mean when trade starts impacting the underlying economy. It's in this number, and it's this number that we need for economic growth in the future. On page 6, we just take a look at a few different interest rate metrics. On the top right-hand side, we show the yield curve, the U.S. Treasury yield curve over different time periods. The end of 18, the end of June of 2018, and then the end of June of 2019. Despite what all of us have been saying, that interest rates are going to be higher, and we've been saying it for a long, long time, interest rates, in fact, head lower. And we had a period of time where interest rates started to tick up, when the Federal Reserve was normalizing their monetary policy and moving from a Fed funds rate of 0 to where we are today of, right around 2%. But with the trade issues and with some, concerns about fundamental economic weakness starting to creep into the market, we've seen interest rates come lower. a lot has been made of what exists today in the Treasury market, which is referred to as an inverted yield curve. Generally speaking, and I'll draw a picture here, but interest rates in the yield curve slopes upward. So that means if you, with short maturity bonds, you expect to earn a lower yield than long maturity bonds. That's generally reflective of an economy that's growing and inflation that's, relatively under control. What we have now is short-term bond yields are more than long-term bond yields. And at least historically, that's been a pretty good predictor of a recession coming at some point in the next, call it 9 to 18 months. Now, there's a lot of debate about whether the current inversion of the yield curve is actually forecasting a recession that's coming. You have folks in both camps. I'm not suggesting to you that just because the yield curve is inverted that we're going to have a recession. In fact, we actually don't think there's going to be a recession anytime soon. We think the risks are higher for a recession, but we don't actually foresee one in the near term.
Give me your definition of near term.
Certainly,
12 months?
Yeah, I would say
18.
certainly not the remainder of this year and probably the first half of next year. We're not likely to see a recession. Now, that would change if, again, things get ramped up on the rhetoric side.
Okay.
But there's a number of folks out there that are viewing this inversion of the yield curve because it's predicted every recession since the 1970s. And they say, whoa, we're worried about this. Maybe this is reflective of some weakness in the underlying economy. We're eventually going to head into a recession. And so this is the dynamic that's going on. You've got a lot of stuff going on the interest rate side. You've got a lot of stuff going on the trade side. You've got lack of investments from businesses. So we're cautious. Again, we're not suggesting that a recession's coming anytime soon, but we look at all this data, and it wouldn't surprise us to see some weakness in the equity markets here the last part of this year. Now, we don't think it's going to be anywhere near sort of catastrophic levels that we've seen in the global financial crisis, but in any year, there is typically a 10% pullback from a peak of a market into a trough. We haven't really had a 10% pullback. So it wouldn't surprise us if we saw something of that magnitude. But we still think, and we're still constructive on stocks because, if the trade thing can stabilize, I'm not even saying getting it resolved. The trade thing can stabilize. You will have an accommodative Fed that's cutting interest rates, trying to stimulate the economy. That tends to be a good dynamic for stocks. On page 7, this just kind of looks at some of the things I mentioned earlier on the top. We look at some different indices about which did better or worse in the second quarter of the year. We sort of touched on that. Here's an interesting chart in the middle on the left-hand side where a lot of the surprises to the economic data, which is in that blue squiggly line, have been negative. So the economic data that's come out has been worse than the market expected, and the U.S. stock market continues to rally. So we see this sort of disconnect between the economy and what's going on in the stock market. Maybe the stock market's really focused on the Fed and the fact that they're going to be cutting rates. There's an old adage, never fight the Fed. So when they're cutting interest rates, stocks tend to go up. When they're hiking interest rates, stocks tend to go down. So now you have an accommodative Fed. But we do see there's this disconnect between equity markets continuing to rise and then some of the economic data disappointing on the downside. So with that, maybe I will, unless there's any specific questions related to the economy or the capital markets, maybe we can talk about the portfolio and certainly weave in some of those views and observations about as we talk about the portfolio. So on page 10, Tom, I noticed in your report you had 204 million in assets, and we're showing 211.6 at the end of June, so we'll have to see what the difference is there.
Yeah, some of it's probably just timing and
Could be.
reporting and, yeah.
Could be. So at the end of June, we had about $211.5 million in the trust fund. We exist because we've promised pension benefits to our employees, and so that means we have a 7.25% return where we discount our liabilities and where we're assuming our investments, we're assuming what our investments generate each year. That suggests to us that we need a pretty aggressive investment policy in terms of our overall stock bond mix, and that's showing up on the right-hand side of page 10. In broad strokes, we have 70% of our portfolio invested in stocks, both in the U.S. and non-U.S. markets, 22% in bonds, and then a little bit in real estate and some alternatives, which I talked about we'll be funding in October. On page 11.
Hey, Brian, can I just ask one question? Do you recall off the top of your head what the discretion that you have over the asset allocation? Is it like plus or minus 10?
I think it's plus or minus 5.
5?
I'm pretty sure. But I can confirm.
So I guess in your discretionary role, we sort of jointly own that asset allocation.
Yes.
Would you, as we sort of move along in the future, and obviously no one knows what's going to happen, if you felt strongly about one way or the other, would you come to us and recommend that we alter that strategic allocation?
So if we, and I think I know where you're coming from, and let me just try to use this as an example, and maybe it's extreme, but you'll get the point. If we had perfect foresight that we were entering into a 2008 period, we would come to the board and we would suggest the plus or minus 5% around the current targets is insufficient for us to protect the portfolio. So we would suggest that we go, I don't know, I'm throwing numbers out, instead of 70% equities, let's go to 50. We obviously don't have perfect foresight. However, I can tell you what we were doing in late 2008 to early 2009, so it'll give you some sense as to how we worked with clients. As you'll recall, back in early 2009, late 2008, everybody thought the world was coming to an end. Everybody was running for the hills. We did our work, and we thought that Armageddon wasn't coming. And if it did, the reality is investing more in stocks was the least of our problems. So when we see opportunities like that, we'll absolutely come to the board on the upside or the downside and suggest to you we need more latitude to either protect the portfolio or capitalize on opportunities that we see that become available. I hope that addresses it, but page 11. So we've got about, in broad numbers, 70% stocks, 30% in other stuff. So how are we allocated at the end of June? You can see a table there at the bottom of page 11, and I'll just call your attention to the average portfolio weight column, which is the second number from the left. So from an equity perspective, at the end of June, we're about almost 74% equities. So a little bbit overweight equities. Actually, that wasn't a bad place to be in the first 6 months of the year. Actually, hasn't been a bad place to be in the third quarter either, because bonds have started to spike up in interest rates. Equities have been volatile, but they've been pretty stable. And we'll talk about some results in the third quarter. But that positioning we feel pretty comfortable with, even though I've talked about our concern about the underlying economic data, okay? Because we think bond returns are going to be challenged as well. So that overweight was really coming from the fact that we're overweight U.S. equities in particular. We're basically right on our targets, slightly overweight emerging markets, but we're basically right on our targets for non-U.S. equities. We are underweight alternative strategies because we haven't been able to fund them yet. So we are going to be reducing that overweight to U.S. equities in the beginning of October as we fund these new alternative investment strategies. So that overweight will be coming down somewhat, but we're still likely to run a slight overweight in equities even after we fund those new strategies. On page 12, here is a snapshot of returns. So I know I've been talking a lot and we haven't even talked about how we've done yet. So the first column of numbers there are the second quarter, the middle column are the year-to-date period, and then the far right is what we call the custom period, which starts in October 31st of last year, which is reflective of the discretionary mandate becoming effective. So again, we ended the quarter with $211.6 million. You can see the change in the market value of the portfolio over the different time periods, the second quarter, year-to-date, and custom period. And maybe I'll just focus on that year-to-date period here. We started, you'll recall, in the fourth quarter of last year, markets were really weak, quite volatile. We ended last calendar year at roughly $188 million in assets. In the first 6 months of this year, we've paid out, on a net basis, $5 million in benefit payments. And we've made $28.5 million. And I mention this because I know there's a lot of discussion, and I was fortunate enough to participate in the city council meeting on Tuesday night, that we're making money with our investments. We're up almost $29 million in investment gains, real dollars, this year that we're using to pay benefits to our beneficiaries. Going back over to the second quarter of this year, and if you go all the way down to the bottom of page 12, our return, this is on a fully loaded net of fee basis, and of all fees, we were up 3.84% for the second quarter. Our benchmark was up 3.39%, so we outperformed our benchmark by almost a half a percentage point, so 0.45%. Talk about why we've outperformed in a second, but moving over to the right, on a year-to-date basis, we're up 15.3 net of fees. And our benchmark is, almost 13.7, so we're outperforming by over 1.5%. And then from that period of October of 18, 11.5% versus a benchmark of 9.7, outperforming by not quite 2 percentage points. So the results that we've been generating together since the discretionary mandate became effective have been quite strong. Now, why have we done so well?
Brian, when you're saying net of fees, does that include Hancock as well?
It's a good question.
Probably just investment.
I think it's our fee and the underlying investment manager fees, but I don't believe it includes
Not his side of the house,
Hancock.
okay. All right.
Which would be another, 6 or 7?
6.5.
6.5
basis points.
So, again, on a fully loaded fee basis, results are still quite good. So why have the results been so good? It's really a function of two things. One, we've been running a slight overweight to equities, and equities have done a lot better than bonds. And number two, we've had some really good active managers that we've retained, and we'll walk through some of those results. I'm going to ask you to skip, slide 13. We show the individual manager returns here, but we don't show a benchmark, so I think a better page for the board to go to is on slide slide 23, where we list each of the managers we have, and we show their performance relative to their benchmarks. So I apologize, this isn't the easiest chart to follow, but I'll do my best here. So you'll see the first grouping of numbers there, something called City of Portsmouth, VA, Select, UMA, and then there's a custom account index. These are all of the assets that we have custodied at Morgan Stanley. Now, we use a number of managers to that underlie this result. So I'm going to skip over this one because I'll show you the individual managers that make up this result in a minute. Going right below that grouping of numbers is BlackRock. It's in that, sort of second row of that table. This is one of our fixed income managers we employ. They were up about 3.1% during the quarter. Benchmark was up 3.1%, so right in line. For the year-to-date period, they're up 5.9 versus 6.1, so slightly lagging the benchmark. Their maturity profile is a little bit shorter than the benchmark. And generally speaking, when you hold shorter duration bonds and interest rates decline, your returns are somewhat less than the benchmark. So that's what's really driving the result here. They're positioning for a belief that interest rates are heading higher, and we actually kind of share that view. The next row is something called the American Euro-Pacific Growth Fund. This is a non-U.S. equity manager for us that we've had for a long time. They invest not only in developed markets, call it 80% in developed markets of Europe and Japan and Canada and places like that, but they have about 20% of their portfolio in emerging markets as well. They had actually a very strong quarter and year-to-date period. They were up 3.9% versus a benchmark that was up 3%. And year-to-date, they're up 17.7 versus a benchmark that's about 13.6. So 400 basis points of excess return. Really good result here. A very big firm with lots of resources and have historically done particularly well for us. They tend to outperform and underperform. We've been together a lot. I don't necessarily get into individual manager performance and why it was good or bad, but they've had some good stock selection in certain sectors. They're over or underweight certain countries that do better or worse, and so over time they've just had a very strong ability to be in the right names and do well for clients. The portfolio below that, the line below it, is Lazard International Equity. This is a manager that we've had going back probably a couple of years now. When we worked with the board as a non-discretionary investment advisor, this is a recommendation we made to the board that was approved. This is a concentrated portfolio. They hold about 30 or 40 stocks, and they had another strong period. They've done very well for us over time. They're outperforming for the quarter by 1.5 percentage points, for the year-to-date period by about 4.6%. The portfolio below that is a short maturity fixed income portfolio. That manager, Lord Abbott, did well relative to its benchmark and overall time periods measured. I'm going to come back to the next one, Rice Hall James, in a minute, because this is the one that is underperforming, and so we should spend a little bit more time talking about that. But let me come back to that in a second if I could. One below that is something called the Artisan Developing World. This is one of our emerging market equity managers. The results here that they've been able to generate have been nothing short of impressive. Year to date, they're up almost 30% versus a benchmark that's up less than 11. So they've outperformed by 19 percentage points. They run a relatively concentrated portfolio as well. They've been in a lot of technology names and consumer names in China that have done exceptionally well coming out of the fourth quarter of last year. I will tell you that in the second quarter, we cut back our exposure here. And we cut back our exposure for a couple of reasons. Number one, they've done just so darn well, so they're probably due for some underperformance. But all of our emerging market eggs were in this basket. We wanted to diversify that exposure. So we cut the exposure back to fund another emerging market manager to get better diversification within that segment of the market. So our timing was actually pretty good. I think when we cut back their exposure when they were up north of 30%. So, but we still have an incredibly high degree of confidence in this manager, and they, in particular, are one of the biggest reasons why we're able to outperform our benchmark at the total fund level. The next row there is alternatives, which that $5 million was invested in a real estate fund at the end of September, so we'll start reporting on results when those become available. That will increase as we fund 3 new hedge fund managers at the beginning of October. We have a money market fund below that generates some rate of interest. This principal global real estate fund, the last row down there, had a strong quarter and year-to-date period. We terminated that manager to fund our new real estate manager, so they are going to go away, but they ended their tenure with us on a very positive note. And then maybe I'll take this time to come back to Rice Hall James, and then we'll talk about the other managers that we have where the assets are custodied at Morgan Stanley. So Rice Hall James is a small and mid-cap growth manager for us. They invest in companies, technology companies, biotech companies that are growing faster than the market, and that they have an expectation that are growing faster than the market. They've struggled. They actually got out of the box for us. We've had an investment with them probably dating back a couple of years now. And the immediate results that they had after funding were exceptional. They did exceptionally well, beating the benchmark. And I would say over the last 12 months or so, it's been much more of a challenge for them. And one of the primary drivers of the fact contributing to their underperformance is biotechnology companies, so companies that are trying to create new drugs for diseases to try to cure them or treat those diseases, are a big component of the small cap growth index. A lot of those companies get bought by bigger biotech companies or pharmaceutical companies. And typically the premium that those companies pay is significant. There were a lot of those kinds of acquisitions in the second half of 2018 in particular, of stocks that this manager did not hold. So it's not that they were losing money, it's that they didn't hold a lot of the stocks in the index, particularly in that one segment of the market, that did exceptionally well because they were bought by other companies. I mean, this is a firm that we continue to watch, that we continue to have dialogue with to make sure we understand what's going on. We have cut back some of our exposure to fund benefit payments, to fund new managers. It's not a manager that we are going to move out of, but we've used it as a source of funds to reduce some of the impact of that dynamic that I just described. If you flip ahead to page 24, I mentioned that first line on the prior slide was sort of an amalgamation of a lot of different investment managers, and here are those individual investment managers shown on page 24. We have an active large cap growth manager, Poland Capital, that we've implemented since our discretionary mandate. They've outperformed over both periods that we're showing here, up 1.7 percentage points for the quarter, up almost 300 basis points for the year-to-date period. Aristotle is a large cap value equity manager. They outperformed by over 2 percentage points for the quarter, and now that puts them up 2 percentage points relative to the benchmark for the year. Delaware is a small cap value manager for us. They've outperformed by similar magnitude. We have a dedicated Japan investment manager, which is shown the second or third row from the bottom, Matthews Japan. They were just funded during the third quarter and towards the end of, I'm sorry, the second quarter towards the end of April, we have a very constructive view of the Japanese equity market. There's a lot going on from an economic and cultural perspective that suggests that companies in Japan are much more focused on generating returns for their shareholders, whereas historically, culturally, that was not their primary objective. So there's a strong dynamic that's underlying, we think, potential of Japanese equities. And then the last one here is this new emerging market manager I talked about. We cut back that emerging market manager that has done so well to fund a new one to get some greater diversification in the portfolio. They were up, not quite a full month's period. They were funded on June 7th of this year, but they're up almost 5%. Benchmark's up a little bit more than that. So through the second quarter, I would tell you, if I were to sort of sum it up here, the results have been very strong. We're beating our benchmark. We're beating our actuarial return assumption. We like our positioning. We're going to be funding some alternative managers the beginning of October, and we'll start to talk about performance from those segments of the market when we have some results to talk about. I did want to give you a sense as to how July, August, and the first couple of weeks of September are holding up. You recall at the tail end of June and really into July, there was some volatility in the market. Again, it was all surrounding on-again, off-again trade negotiations. As we looked at the total fund, we were up slightly in July. We were up about 1/4 percentage point. And then August was, again, a volatile month. So we were down in August a little over 1%, about 1.2%. So you add those two together, we're down about 1% in the first 2 months of the third quarter. Interestingly, September's been pretty strong so far. The start to September has been pretty strong. So it's my estimate that we made that 1% decline back in the first couple of weeks of September. In fact, we're probably up a little bit now in the third quarter. So again, the results are strong, and I think it's a function of exposures, it's a function of the managers we have in place, and it's a function of the decisions that the board has made in terms of how, from a long-term strategic perspective, we want to be allocated. So with that, I will stop. I know I kind of went on for a while. Happy to answer any questions that anybody has.
Brian, what's the overall strategy for the rest of the year, especially with being overweighted in equities?
Yeah. I think we're going to cure some of that overweight by the funding of new managers in 2 or 3 weeks. But it's our expectation. We've started to see this in the first week of September, that interest rates are heading higher. Now, I think the Fed is probably going to be in the rate cutting mode, but I think longer maturity interest rates are probably going to start ticking up. And we've seen that really in the first week. I think the 10-year Treasury yield, I didn't look yesterday, but I think it's probably around 270-ish.
170.
I'm sorry, 170. And I think we got down to about 140. So 10-year Treasury yields have already started to tick up, 25 or 30 basis points. That means bond returns are going to be weak. So we don't necessarily want to be there. And as the Fed cuts short-term rates, it's probably going to, give some life to the equity markets and continue some equity market strength. So I think we're pretty well positioned. We're a little bit overweight. We're going to cure some of that overweight by funding the alternatives managers. But it's where we want to be. Now, if we see something change dramatically, where we think a recession becomes more imminent, something happens on the geopolitical side, then we're going to want to cut back in that risk exposure. But from what we know today and how we think the rest of the year plays out, I think we feel pretty comfortable where we're at.
Is your alternative investments, is that meant for the long term, or are you in it pretty much for the short term and see what you can get out of it?
What's your strategy on that?
Our strategy there is to add some diversification to the portfolio. So we want that exposure from a long-term perspective. Now, might we change? Alternatives is a broad category. It doesn't really mean anything, right? We might want certain exposures within it, in that 5% that change over time based on what opportunities are available in the capital markets. But we want some additional levels of diversification from that exposure relative to our sort of equity orientation. Now, 5% isn't a huge number, right? One of the dynamics that we're grappling with at the city of Portsmouth is the fact that we pay out such a large percentage of our assets in benefit payments each year. So again, in round numbers, there's $10 million in contributions, there's $30 million in benefit payments that go out the door, so $20 million net negative cash flow each year. On a portfolio that's $210 million, that's a little bit north of 10%. We need a lot of our portfolio to be liquid. And so I would suggest to you that all else being equal, we would probably want more alternative exposure for that diversification, but it doesn't make a lot of sense here because we've got that big negative cash flow position that we have to deal with.
You've been watching Rice Hall now. I think this is the second quarter we've talked about them
It is, yeah.
underperforming. So what's the outlook there and what triggers?
Yeah, that's the art behind what we do. You know, there's some science to it, and we put numbers and run models and quantitative data that helps us structure a portfolio. And then there's the art of what do you do when something's not working, and how long do you give it? And there's no real good answer for that, Ms. Bellin, but let me try to give you some insight into what we think about and how we approach it. Before we decide to hire and retain a manager, we do a lot of work trying to understand what it is that's unique about that organization that is likely to afford them the ability to be able to outperform the market. And it could be sort of a unique way at looking at the world. It could be some unique quantitative metrics. It could be experience of people and those kinds of things. And inevitably what happens is active managers go through a period of outperformance or underperformance. And when things are working well, everybody's happy. And when things aren't working out is when we start to sort of refocus and to rethink, well, what did we get wrong? Did we get anything wrong? Has what that manager expressed to us, have they changed their strategy? Have they changed their stripes? Is it some dynamic that's going on in the market that is contrary to the style in which this maybe manager invests? And so it's understanding the root cause as opposed to maybe the underperformance itself that drives us to make a decision on whether to keep a manager or to pull the ripcord. In the case of Rice Hall, you know, they've picked some stocks that didn't work out. There's no question about that. Everybody does. That's the dynamic of active management. To the extent we're going to have active managers, and we think we should, there will be periods where they will underperform. I can assure you there will be periods when we talk about some of the other managers that we have in place that are underperforming as well. Part of my job is to make sure we don't make sort of a rash decision, because what tends to happen is active managers are hired, and the ones that underperform tend to get fired and terminated and replaced with somebody else that did better, and then those two trend lines change. So the manager that's underperforming tends to start to outperform, and the manager we hire that outperform tends to underperform. So there's this sort of mean reversion that oftentimes is at play with respect to active management. With respect to Rice Hall, we've had a number of meetings. We've had phone calls, both my team and the folks that are on the phone. We've visited on site with Rice Hall earlier this year to get our arms around what's going on. And we really believe that a big portion of their underperformance is the stocks that they didn't own in the index. Now, that doesn't make it right. And a lot of those stocks that were bought were companies that were acquired, that were companies that this firm was never going to invest in anyways. And so there's these dynamics at play in the index that have been driving that underperformance more so than conscious decisions of the manager to pick this stock versus that stock. So that gives us some comfort that what they're doing hasn't changed. The market dynamics has changed. Now, that being said, it's not something that you want to sit around and continue to watch underperformance. And so we've cut back the exposure. We'll continue to watch it. If it becomes clear that the more recent underperformance is a function of more sort of proactive and conscious decisions of the manager, we'll have probably a different decision to make. But we're comfortable where our exposure is. We still think this is a very good manager. And that was a long-winded answer, which I don't even know if I answered your question, quite frankly. But this is the thing this is the challenge. This is the art of what consultants do. And
So the first step you've done is cut back the exposure, but you're still watching.
we're still watching. We still think they're a good manager. We still think over a long period of time they're going to add a significant amount of value for us.
Okay.
Really, the last 12 months has been a challenge.
Thank you.
Sure. Any other questions? Okay,
All right. Thank you.
thank you.
Yeah, thanks a lot. It's nice when we change the mandate and then right out the gates, such strong performance. So
Benefits.
I know 9 months doesn't make a track record, but
Let's just lock that in.
good start.
Well, thank you, and we appreciate all the confidence that the board has placed in us and in our firm. And Landon, I would concur with you that it's always so much of your success with an advisor or active manager really depends on how they do immediately after you hire them.
That's right.
And we're fortunate that the results have been.
This was a good meeting for you to come to.
It was. But I also want to make the point. We're doing this together. I mean, the board is focused. The board is committed. The board has spent the time to set the policy. And a lot of the results that we've been able to generate are because of the decisions that you all made. So I just want to thank the board for their attention to the plan. And hopefully we'll continue to have good news to talk about.
All right. We'll get back to the agenda. Update from the city council meeting. Ms. Spivey, you got that?
I have that. Yes. We have discussed that the city's financial advisor brought to us the opportunity to refund the pension obligation bonds for potential savings. And prior to, and that moved forward. At the same time that city council voted to move forward with the refunding, they also voted to dedicate any savings from the refunding to go straight into the pension fund. And I'm going to read you an email that we received from Mr. Kyle Louts with Davenport right after the bond sale. If you remember, he was thinking that we would save maybe $5 million, somewhere between $3 and $6 million, thinking it was about $5. He's after the sale, he sent us an email and says, "We're excited to write to you with the results of today's competitive pension obligation refunding bond sale. The results are highly favorable for the city and surpass the estimates we had previously discussed. In summary, the city received 8 competitive bids from financial institutions for the roughly $128 million bond sale. The winning bidder was Raymond James and Associates. The other bidders were Jefferies, Bank of America, Merrill Lynch, Robert Baird, Citigroup, J.P. Morgan, Morgan Stanley, and Wells Fargo. The winning all-in interest cost was 2.63%, which is substantially better than the preliminary estimates that were in the low 3% range. This result is due in large part to the recent and substantial declines in market interest rates. The interest rates for the bond issue is fixed for the entire term of the bonds, which is roughly 18 years. The final net savings is slightly over $9 million, or 7.5% on a net present value basis. You will recall that we had discussed with City Council and the rating agencies an estimate of roughly $5 million in savings. Thus, the final savings is approximately $4 million greater than the market estimates we discussed in July. We continue to recommend that the city dedicate all of those savings to the two pension funds to enhance their funded status and ensure that the two funds are sustainable and financially strong for the city and its retirees. These highly favorable results are due to a number of factors, but primarily amongst these are the city's favorable reports from the credit rating agencies. The fact that the city's ratings were currently affirmed allowed it to quickly react to the decline in the interest rate and lock in these substantial savings. Thus, in closing, we'd like to congratulate the city on the great outcome and continue to stress the importance of maintaining strong credit ratings for the city. That was a great bond sale. We hit the market perfect. Where we've been talking over here, we're looking for high yields. For I call it my side of the business. We look for low. So we hit the market on a great day. That was as the yield curve was inverting. Great. It was a great thing for us to have done. Now to talk a little bit about the logistics of how the savings that goes into the pension fund works. So we have budgeted, right, the city now has budgeted and planned to make the debt payments as they were structured with the original bond sale. So now those payments are lower. And the city chose to take the savings up front. So what happens is when we sell bonds, we always have to make the interest payments, but we have the ability to restructure the principal payments. So that's what we did. So the principal payments are lower in the earlier years. So most of the savings we will get as in the first year. I think we get close to $6 million in the first year, and that's because we're basically paying no principal, but paying the interest. So the interest rate is lower. So the difference between what we had planned to pay and what we will pay, we will take an ordinance to City Council to say, instead of making debt service payments, we're going to be making pension contributions. Same amount, has no budget effect, but it allows us to put more money into these pension funds. And then the same thing will happen in the second year, which is the first year is fiscal 20, second year fiscal 21. That will be a lower difference because again we took our savings up front, and then there's a even smaller difference that goes into year 3. So we won't make the contributions into the pension funds fully until the third year. But again, most of it is in the first year, some in the second, and some amount in the third. So this is, I feel like this is great news for our pension funds.
So the contributions to the pension fund will be one time or monthly?
It's, we make principal payments on bonds once a year.
Okay.
And I don't recall which month it is, but when we make those, the way we will set it up for city council, and they've already approved putting the savings into the pensions, is that at the same time we're making the lower debt payment, we'll make a contribution to the pension. So it'll be three different times.
That's good news.
I echo, that's very good news.
That's
And,
awesome. I'm sorry. Will you be able to provide what that schedule and estimated amounts are?
I will, because I'll be working up an ordinance for city council. So when they get it, after they've approved it, I'll get it to you.
I've got a question on that approval by council for ongoing contributions from the savings. Is that something that could change with different council people?
But Derek might want to.
I mean, could they say, we're going to take that savings and put it in general account? or
No
what?
board can speak for the next board, so.
Okay, all right, you answered my question.
But it is, we do have an ordinance, so.
Okay. Thank you.
That's great.
All right, while we're talking about city council, Mr. Attorney Challenger reminded me that a year ago, just about, our board presented an update to city council. And we're expecting that will come around again soon. I don't know if we have a date, maybe.
September 23rd.
September 23rd. And he sent me a link to the YouTube presentation. I forgot I was in the meeting, honestly. But, so I guess it wasn't traumatic. And all of the members of the board, if you would, mark your calendars. I think the meeting is usually at 6.
It's Monday, September 23rd at 6 p.m. right here.
Here?
Yeah, the public works section.
Okay. And typically, I'll do an opening statement as chair, and then Mr. Ashby and Ms. Spivey do the other presentation. That's what I saw,
How it was last year.
how it was last
Monday,
year.
September 23rd.
And the rest of us just kind of chimed in. So if it goes as it did last year, that's our process. Would you forward the link to all of the board members? I found it beneficial to watch it, and especially some of the questions that they presented to us, like how we were tracking versus other pension plans statewide. And they wanted us to do like a 5-year look back on the performance of our funds. So as we watch that, and as you watch it, perhaps we can share any feedback of things maybe we need to be prepared for, not knowing unless Mr. Glover can give us some insight exactly what they'll be looking for. I'll put you on the spot.
6 to
No,
6.
I mean, overall, I think that just how it was presented here today, I know Mr. Birnbaum presented just on Monday night, Tuesday night. Was it Tuesday you came in?
Yes, sir.
Tuesday night, and I just think hit the highlights. I mean, the same way you presented probably before would be a good thing.
Week and a half.
Okay. All right.
Have you confirmed that with city manager, that date?
It's on the calendar, but I haven't confirmed it, but I will today.
Okay, and if it's any different, we'll get a message out. I don't, she was talking about the calendar yesterday, and I didn't remember that on there, but I could have just.
Okay.
If we could get a confirmation so that everybody can put it on their calendar. Okay.
Right, that's why I was asking.
Yes. Thank you, Mr. Challenger. I appreciate that, too.
No problem.
Then the final item on the agenda, resolution for the attorney's annual conference on pension plans?
Our office prepared a resolution requesting authorizing payment of $3,000 annually to the Portsmouth City Attorney's Office to offset costs of attending the National Public Pensions Attorney Conference annually. This particular organization has conferences twice a year. This past year is in San Diego. There's two different sessions. There's a winter session and then there's a summer session. The winter session is in Tempe, Arizona. The actual summer session changes location so that it can be convenient to different members across the country. We found it to be very helpful, and for two reasons. One, the educational component of it. The other component of it that's been very helpful is best practices. And it's really important for us because we're not, this is a smaller pension board. It's not like the state of Virginia or some large state, so it's helpful for us to be able to meet with attorneys all over the country who do this, so we can actually know exactly what they're doing in their own particular offices and their own particular jurisdictions. I know historically the retirement board has done this piecemeal, and I know sometimes that our office has come in one particular year and asked for $5,000 or whatever it may be. The purpose of this is part of our ongoing effort to make this codified, so that every year this is the same thing. It goes into the whole idea of making this a continuing thing every year. So we want this resolution to offset the cost of registration, travel, lodging costs. So that's the resolution that we have put forward for $3,000 annually.
No. So resolution mean that it's becomes part of our bylaws or part of our budget? What?
It's just a resolution, right, that says that the chair, chief financial officers are hereby authorized to take necessary to implement this resolution. So
Okay.
we're not asking for this to offset what's already happened for the past conference, but for going forward.
Okay. So we need to vote on the resolution.
Yes.
All right. Board, any questions?
I've got,
And we've paid for this in the past,
Yes.
and it's, I guess, no restrictions to use assets of the pension to pay stuff like this?
No, not that I'm aware of, and not only that, actually, I would even go as far to say that I know now we are actually, this past year, taking on the role of doing the annual education component, and that's something that we plan on continuing to do. So actually, every time we go to the conference, we always do an update. So that's part of the continuing education that's being provided to the board. So it's a direct expense that's directly tied to the corporate governance of the board.
does this board have a budget, or do we work off city money, or what? How do we pay for this stuff?
That was my question and comment, that it would, the only way the retirement board could pay for it is for it to get built into the annual contribution, which I guess we'll run through the action.
I mean, it can be invoiced as an expense. Is that
Right,
what you're saying?
but it would, I mean, the retirement board doesn't have a budget.
Right.
So it would, so any expenses that come out of the plan get built into the annual required contribution. So ultimately, it would increase the city's contribution to the pension plan to then pay the attorney's office. Anyway, so that's just, that was, the concern I had. It seems like maybe the resolution might be more appropriate to ask city council or to include that in the city's budget if it's something that you want to do. I
guess the city pays for it one way or the other.
That's right.
Well, how are we handling training for other boards?
Well, even this, the city attorney's office has a training budget. It's,
So would this 3,000 come out of the city attorney's
that's where,
budget?
That's where it currently comes from. So like right now, the funds.
Okay, what are you asking?
To
us?
reimburse his costs.
Yes, and part of the reason why, as opposed to the other costs of the city attorney's office, this is a specialized type of thing. It's not, the city attorney's office is generally more of a general counsel type role. And so, for instance, the National Association of Public Pension Attorneys is a very specialized board that we only do because of the this particular board, as opposed to a lot of the stuff that the city attorney's budget is generally for. It's for the general stuff that's more routine.
So what you're suggesting is to make a request from city council to cover this expense?
If that's your pleasure. I think that's the only way it could be handled, because ultimately the city's would pay. So
Yeah, because we don't have a budget, I'm not sure how we could approve an expense.
Well, we can if we don't have money.
Yeah, our only resources are pension funds.
Why not, I'm sorry, may I make a comment? Why not make a request just as through the normal budget process, if that's what you do? I mean, this is just HR viewpoint. If the additional money is for the city attorney's office to go to the training to supplement the board, because that's what you're required to do as part of what you do, my suggestion would be is during the budget process, if you need additional money to support that, it should come from that budget. I understand it all comes from the same pot of money, but my thought is from optics standpoint, we just listened to talk about our funds and our assets. We should use our assets to pay out the benefits as opposed to pay for, it's just an HR opinion.
No, I've got a problem with using pension benefits to pay for meetings. I do too.
yeah, and that was my concern originally. So go through the city manager's budget process to ask.
My other comment, kind of question too, is that the ongoing education, you represent both the city and the retirement board in best interest, so is all each working together to protect both groups. So
Just listening, I would agree with Miss Gooden and Miss Spivey. I think that's the best way to handle that type of request.
So our recommendation is that you would go through the city's budgeting process as recommended by both of our code officers, ex officios, I forget the name. Okay.
That's right.
Not that we don't support it, it's just that we don't have a process to pay for it.
Like you want to pull out your checkbook.
Or yours. All right, so do we have a motion to decline it just to make it official?
Oh, we'll just withdraw.
We'll withdraw. Okay, all right. All right. That's the end of the official agenda. Is there any other comment or?
Are board members' terms coming up? Is it September to September for the board?
If I may, I do believe there is, one of the board members' terms is coming up. I believe it's,
I'm 2020.
I think I know Chief Harrington's, I believe. I'm not sure about the others. I know that
It's a 2-year.
the clerk is looking to do some replacements, I believe. She got in contact with us to get some names of some other viable candidates. I do know for the fire representative. We'll double check on the others.
Mr. Chair, I have a non-agenda item. I'd like to introduce someone new to our office, and we'll it's here today and will be part of our discussions in the future. This is Miss Dora Jaje. She is new. How bad did I butcher it?
You had it perfect.
Okay. She is new to the finance department. She she's in the finance assistant position, which is the position that Ms. Vargas had before she got her promotion into HR.
Oh, congratulations.
So Ms. Jaje will be transitioning to the secretary of this board. Maybe over the course, she's here today, and maybe next month the two, if it's okay, with HR, the two work together. And as Ms. Jajay probably, will take the position officially with the retirement board September, either in October or November. So we are so excited to have her as part of our team. We've had a huge void since Ms. Vargas has left, and just wanted to introduce Ms. Jajay.
Welcome.
Welcome.
Thank you.
Sorry we didn't acknowledge you at the beginning. I
No,
just
that's
thought you were.
fine. I appreciate it.
You
Thank
already
you.
fit in. Speaking of September, we usually get our new parking passes. I think they expire this month. So we could have them for our next meeting. That way we'll all be
Legal.
legal. We don't want Danny writing tickets. Anything else? I'll entertain a motion to adjourn.
So moved.
Second.
All in favor?
Aye.
We will see you on the 10th of October. Thank you.
When is your meeting? Is that out of town?